We view part of our day job at Trivest is figuring out creative ways to drive organic growth to our portfolio companies. What investors enjoy are exits and distributions as much as they like the capital calls. And it's really kind of getting them to say, like, hey, I'll trust where you're taking me. I trust where you're taking this business.
Welcome everyone to this month's episode of the Third Thursday Themes webinar series. I am very pleased to welcome my good friend Jamie Elias to our series. Jamie, thank you for being here.
Thank you for having me.
So Jamie is managing partner for Trivest Partners, which is a lower middle market buyout firm based in South Florida, down in Miami. We've known Jamie for a number of years now, going back to an initial investment that we made with them about 4 years ago now,
Right.
I think, if I remember correctly. So Jamie, give us an overview of your firm, your strategy, and the theme that you are focused on today.
Great. Thank you for having me. Appreciate our relationship with CAZ quite a bit. As you alluded to, we are actually one of the oldest private equity firms in North America, founded 45 years ago in 1981. And as you said, based in Miami, Florida, Coral Gables specifically, but we have satellite offices spread around the U.S. and Canada. The niche that we've carved out is specifically and exclusively focused on founder and family-owned businesses in North America, roughly generating 20 to 250 million of revenue. We invest across four fund families in that halo of founder and family-owned businesses. 3 of the funds are control-oriented. 1 of them is non-control, where we're taking less than 50%. On the control side, it's just the size of the business at the time we invest gets routed to one of those 3 pools of capital. Think small, medium, large businesses. Today we oversee 52 platform companies across those 4 funds, and we've grown our AUM to $6 billion as of now. And we believe we're one of the most active lower middle market sponsors in the nation. Last year we closed over 70 transactions. I would say we're averaging 60 to 70 closed transactions on an annual basis, split between platform investments and heavy add-on activity. What investors enjoy are exits and distributions as much as they like the capital calls, and we're very proud over the past 2.5 years. We've exited 16 businesses, so think an exit every 2 months in a market that we'll talk about that is difficult to exit. And on those 16, we're averaging about 4x gross return on invested capital, which we're pleased with. And finally, we have 100 employees. About half of them are deal team or investment team members allocated to one of those 4 funds. The other 50 support those four funds in the areas of business development. Think looking for add-on acquisitions, portfolio support group that's doing a myriad of operational help to these founder-owned companies, legal, operations, accounting. It's kind of all hands on deck, all driving towards what we call the path to 3x, which stated simply is we're trying to triple the value of a business or our investors' money in a 3 to 5 year period of time.
I am really excited for this webinar, even more so now that we're getting going, because there's so many things about your business that make it very unique and differentiated. And I hope you'll share more of those little quirks about the way you guys run your business and the way you bring your investors in to the various aspects of your business. But here at CAZ, we're very well known for a saying we have, which is if we can get comfortable with the downside, the upside takes care of itself. Our investors have heard that a lot, and they're going to continue to hear a lot from us, so don't get tired of it. It's a mantra for us. So let's talk about the downside. What are the downsides of this area that you're focused on, founder and family-owned businesses? What's the worst case scenario? How have you guys come to quantify and qualify those risks, over the last, you said 45 years, which is a pretty incredible time frame?
Yes. Yeah, I've been at the firm for 26 years, so I've certainly seen thousands of businesses, and the other partners at Trivest have, 20 plus years of experience as well. I would say it's all over the news. There is a steady stream of founder-owned companies coming to market as the baby boom generation slows down and fully retires. So, I think about more of the macro risk to our business, right? And those would be obviously a recession. LPs lose interest in the lower middle market. I would view that as a lower probability. I think the risk that has emerged lately that is garnering more and more conversation in our investment committee is AI, actually. And so it's all exciting and everybody's talking about it, but it is still unknown the impact it's going to have on small to medium-sized business. I can give you the glass half full answer, and I can give you the glass half empty answer. And so we are already starting to embrace AI as a way to help our businesses. But when we're evaluating new investments, we have to critically think about what this business looks like, 2 years from now, which for the first 20 plus years, we're always in investment committee saying, what's the industry like when we go to exit in 5 years or 10 years? Now it's a much faster window that we have to operate under. So I would certainly say that AI risk. You pick the geopolitical risk out there. We say there is always something. You have to have a posture that you're looking for a reason to say yes to make an investment. That doesn't mean we're cavalier and careless. We're clearly not, based on our performance. But I think a lot of our competitors, it's just, how do I say no? And so you have to look at these risks, embrace them, box it, and be careful on how you structure and value a business that typically lacks certain elements that you would see from a public company or a large private company with 400 or 500 million of revenues. These are founder and family-owned businesses that had a great idea, and the founder and the management team got it to a certain level, and our goal is to bring scaled capabilities to that firm, and that's why we built such a large organization, because it's a lot of hard work and rolling up the sleeves doing what we do, which we think is the key to our success.
We talk a lot internally here about headwinds and tailwinds. And one of the items that's on our investment committee memos is a question that says, where is the wind? Meaning, is the wind in our face or is the wind in our back? And we'll invest either way. We just want to know. And so when you think about headwinds for your theme and with founders and family-owned businesses, what are some of those headwinds that you feel like you're facing thematically in the world today?
I think it goes back to those macro risks, right? I think that both getting through a diligence process and exiting a business, right? There has been so much growth in the private equity asset class. It's not like it was 10 and 20 years ago. Less competition. You have to be on your game, and you have to bring more to the table than just capital. And so the biggest risk, and I'm not talking about my firm, I'm saying in general, I do think you could see a little bit of a washing out of a single private equity firm that has done the same things over and over. I think that is heavily weighted towards financial engineering and the ex-investment banker that just does deals. That doesn't go as far as it used to, because the business owners in our world are selecting a partner that can help them get the second bite of the apple to be as valuable as possible. Even when we buy a control stake in a business, it's extremely rare that we buy 100% of a company. Typically, the business owner is retaining 10, 20, 30% stake in the business. And now you're competing on, in his or her mind, who's the best partner to turn that rollover investment into 2, 3, 4, 5 times that amount. And so I think that just doing the same things, paying a high price because you're competing with 100 other private equity firms to acquire an asset, and just offering relationships from some operating partner that might be on the tail end of his or her career, that doesn't work anymore. You need to come in and say, hey, we can sit side by side and really help the business get to the next level.
Yeah, I remember when I came to your annual investor conference, I think it was in 2022 or 2023, so a few years ago now. It was my first real experience to see the ecosystem that Trivest has built, thinking about your comment around founders and families and why they pick you guys. And I was blown away at the force of support from amongst your founders and the companies that you guys own, who are now investors back with you. I mean, they are very strong followers of what you guys are doing, and many of them, it seems like, had taken proceeds that they had earned, hard earned over time, and were reinvesting it back with you guys. And you had done this, really what we've done, which is create a virtuous cycle of creating happy investors and creating wealth for them, and then reinvesting with you, and then the alignment of interest that comes back around from having that circle of capital staying within the ecosystem. So I give you guys a lot of credit for that.
It's what we're trying to do on that first founder meeting, which is typically 60 to 75 minutes over Zoom, and you have 18 to 20 minutes to give the Trivest pitch, which we've just upgraded to 13 very purposeful pages. What we're trying to do is create a vision that the founder trusts us, basically, and trusts that he says, I trust where you're going to take this business. And part of that is creating a sense that they will be joining a quasi-YPO group, a YPO network of like-minded individuals with a common goal of tripling the value of their equity in a 3 to 5 year period of time. And it's interesting to see, and we do CEO conferences where we bring them together, and we're really stressing that we view part of our day job at Trivest is figuring out creative ways to drive organic growth to our portfolio companies. And that's done in a myriad of ways that you probably saw bits and pieces of at our conference. But, a prospective founder that is considering partnering with us, I start every founder meeting, and I've done thousands of them, with the same corny joke, which is, Mr. or Mrs. Founder, can we get something off the table? And they go, yeah, what is it? And I said, I just want you to know that I know you have a negative impression of what I do for a living. I work in private equity. And I always get kind of a smirk or a chuckle, and we're looking for that body language, because that's the unspoken, that's the elephant in the room. Most business owners read the Wall Street Journal, read their local paper, and typically those articles have a negative slant on the industry, right? It's still the barbarians at the gate. I'm aging myself, in the 1980s, where you sell the company off in pieces. The game has changed. And so the first dozen years I was here, and many years my partners were here, we would try to tell a business owner why that impression of private equity was not fair. And let me tell you about all of the positives. You're investing many times state employees, corporate pension, right? And the money that we give a founder can go to charitable causes. It doesn't matter. That's not what they're thinking of. And so we get that off the table. And the one stat that I am most proud of and resonates the most with business owners is, as you know, we've had a lot of investing success. So when we fundraise, we're fortunate in a very difficult fundraising market. Typically, we're in an oversubscribed scenario where we have more demand than we feel comfortable taking on. But for a business owner, we say, hey, if you choose us, we might not be the highest valuation. We have to be close. But if you choose us, you're part of the family, and you have an ability to invest in future funds on the same terms as everybody else. And we're up to, I think, 65 business owners and their families did a transaction with us and thought that the way we structured the transaction and the way we were honorable, ethical, and good stewards of the business alongside them and their management team, that they're investors in the fund. And that is when the body language changes on the call, and it switches from defensive to, now you have my attention, and let me tell you about your business. That's one of the only things that can explain how we close 75 transactions last year when a typical, single fund private equity firm, you would tell me better, it's 5 to 10 transactions a year or less.
That is like 6 a month. That's 1.5 a week. That's pretty astounding pace. Yeah, that sounds like the speed of CAZ to me.
You get gray hair on my head as a result.
Well, okay, so let's talk about the other side of the coin, tailwinds, right? What's happening in your area that's exciting you? What should investors be thinking about when they think of the lower middle market, generally speaking, but founders and family-backed companies specifically?
Yeah, I think at a macro level, there are literally over 300,000 companies that would be technically in the lower middle market. We're talking revenues of, kind of 5 million to 250, 300 million. So there's a few 100,000 businesses. I have great appreciation for what the mega cap sponsors are doing, right? They're investing huge sums of capital into businesses generating 500 million in revenue and above. But there's only, 5 or 10,000 of those companies. And so, the tailwinds are, if you're an investor in the lower middle market, there's a lot of fish in the sea, right? Where we, as impressive as the 75 transaction we closed last year, we've built a very formidable business development arm, which goes out and finds a transaction before it finds us. We brought in, I think 4,500 opportunities were logged into our database last year. Of those 4,500, we looked at the website, we got some cursory information, and we thought about 1,000 were interesting enough that we wanted to get on a call or a Zoom with a business owner. I think it's around 4 a day. So if I walk around the office today, I'm going to hear some investment team member going through the Trivest pitch, which we've tried to systematize. And then of that 1,000, we closed 75. And so, with more opportunities to look at, Warren Buffett says you got to look at a lot of pitches coming over the plate before you swing. So, you have that one tailwind on a more of a macro basis. And even businesses that have 20 to say 100 million of revenue, you have an ability to go in there and work with the company and turn the boat fairly quickly. Fairly quickly could be 6, 9, 12 months. You start seeing the fruits of the private equity firm's labor. I think personally, you buy into a business doing $1 billion, $2 billion of revenue, the big mega cap, and it's more of like a cargo ship or a freighter, if you know what I mean. They do a great job, but it takes much longer, and I think you're more correlated to the public market, small, the S&P 500. We can grow a business in a recession, right? Because the revenue base is still so small relative to the total addressable market we're playing in, right? If we have the right management team, they can take market share from competitors. And then the final thing I would say, more specific to our strategy, which is I've been in countless investor meetings saying, hey, like, why founder and family owned business? It's interesting. It might be a little odd. And I always give them the same answer. Founder and family owned businesses are not managed to their own. Founder and family owned businesses are not managed to their true potential, meaning they get to a certain level of profitability where the family says, it's enough. Like,
Yeah.
we're good. We distribute 5 million, 7 million, 10 million, 2 million, whatever it is. Every family, every founder says, hey, I'm good. And we see that's when they don't go and pursue the obvious growth opportunities that are right in front of them because they're good. You know, life is good. And so we can go in there and help turbocharge those very obvious growth opportunities, both on the organic side and on the inorganic or add-on acquisitions. I would say 8 to 9 times out of 10, the business owner has never completed an add-on acquisition before we invest. When we're exiting, we are averaging about four to five add-on acquisitions completed on that portfolio company by the time we exit. So by the time we exit, the larger private equity firms and strategics that are typically acquiring a Trivest portfolio company sees a business that has ramped up their organic growth and are viewed as a consolidator, and sometimes the consolidator of choice in their niche sector. And that's when you create a must-own asset, which is what we're driving towards as part of the sort of the transformation and the 5 years they're typically with us.
You know, one of the things I hear the most is that if you can buy a business that's already proven to be able to do those acquisitions and has the team that has the horsepower to be able to continue to do that, it's you can afford an extra turn or two
easily
of multiple on it because of what the business can still do after the fact. So let's use the CAZ scale here of a 1 to 7.
Yeah.
1 being lowest possible, 7 being the highest possible. I like to pose this scale to people because 1 to 10 is what everybody's used to. 1 to 7 requires you to be a little bit more exacting. With 4 being kind of, hey, this is standard, still attractive. 4 is not unattractive. 4 is what you expect. So where are we today? 1 to 7.
You know, I think I'm gonna give you a little bit of the more macro and then come down to our market. I think that private equity right now, despite our success with exits, it's been a much slower period of exits, really since interest rates rose in April of 2022. You could see a marked slowdown, and then you had inflation and all of the things that we dealt with. And so I think I would probably peg it in the 5 range, 4 to 5 range in terms of where we're at right now, because the fundraising cycles are taking longer. And we Trivest, we are seeing odd behavior from other private equity firms in the middle market, in that if you haven't had enough exits, once a fund is 75% invested or deployed, as we say, you know, the senior people at that firm better start fundraising. The issue is, if you haven't had enough exits in the past 3 or 4 years, you might not have the confidence that that existing investor base is going to stick in there and you're going to raise a fund the same or larger than the last fund. And so it's creating this weird virtuous cycle where there's some firms out there appearing busy, and we're hearing this from the investment bankers that sell our companies, and they tell us these stories of think of firms just kind of going through the motions, right? We're selling something every other month, and so our LPs are used to getting distributions, and we focus on it almost to a maniacal sense to make sure that we're punching it in the end zone when we have the opportunity. So that's why I'm typically a glass brimming over type. That's why I give it more of a 4 or 5. I think firms with a differentiated strategy within the lower middle market, our differentiated strategy is founder and family owned business, and bear hug the companies with significant help and resources on the add-on front and on the operations, legal, marketing front. I'm very bullish. I'm a 6 because I know that with a differentiated strategy that's proven and repeatable, and you focus on the front end of your business where you continue to have a lot of opportunities to evaluate, so you don't talk yourself into doing a transaction simply because you haven't really done much in the past 18 months. I think that those firms will generate returns materially better than any public or, any benchmark that you can show that they should outperform handily.
Every asset class or niche or theme has various, not necessarily stigmas, but common conceptions or even misperceptions about it. And I'd be curious what those are for your niche, for your theme. What do you think people are not appreciating the way that they should, or what do you think that they misunderstand?
I mean, I think that, I always joke when we go through the process of finding a business, doing the diligence, and then working with the company for 3 to 5 years. There are literally thousands of decisions, large and small, that are made throughout the course of that investment. And when you get to the other side and you have a successful investment and the investment generated a 3 times multiple of invested capital, it always strikes me that the recipient, the investor, whether it's a wealthy individual, a pension fund, an endowment, whatever, they read this memo and they're really just focused on 2 metrics: multiple of invested capital and internal rate of return. And I would say that, I said that to one investor and they said, yes, and you're paid handsomely for that, right? And then the terms of our promote and all that stuff. That was not my point. It's understanding that generating these returns is really difficult, hard work. And we feel the pressures of the fiduciary responsibilities of being entrusted with literally billions of dollars of other people's money. At Trivest, the people that make up Trivest are the single largest investor in the fund, which for obvious reasons. It's because we think that opportunity is so great. But I always feel like there's a little bit of a conception of, hey, go find a business, buy the business, and attend a quarterly board meeting and offer some thoughts in a quarterly board meeting. I'm trying to paint a picture of the Sunday at 6 p.m. text from the CEO, do you have 5 minutes, which is 45 minutes on a Sunday night, right? And we do it because we love it, and we know that's what's required to have top decile returns. You can't mail it in. And if anything, I don't know, you tell me how many private equity firms out there, 3,000 or so. To stand out requires extraordinary effort.
Thank you for that. There's 3 things, as I'm standing here reflecting on our conversation here, 3 things really stand out to me. The first is the alignment of interest you have with your investors. You mentioned that the team is the largest single investor in the various funds, more so than anyone else, and that very much aligns with CAZ and our substantial investment in our own vehicles. The second is your operational expertise. You just kind of went through it right there, but your ability to go into these companies, understand how to make them better, how to make them generate more revenue, be more profitable, and do the M&A integration, which is really helpful in your area given all the supply of companies available to purchase. Right. But the third thing I was really struck with earlier in the call was the psychology that goes into what you do. Yep. And how you are very thoughtful around how you present the firm, understanding your target market with founders and family-owned businesses, and understanding their psychology. Why would they be hesitant? Why would they be excited? And how to position it in a thoughtful way.
I joke that up until about 5 years ago, I interviewed everybody that worked at Trivest. It's kind of gone beyond me now. But I would always sit a young, MBA or some associate that has spent the last 10 years preparing for an interview at a private equity firm. And I would say, hey, let me ask you a question. what type of job do you think you're interviewing for? And they, this is a trick question. No, just what do you think? Well, and it's 8 times out of 10, quantitative finance position. And I go, yes and no. And they always look confused. And I say, you're interviewing for a sales job. And they go, a sales job? And I said, yes. Being able to connect with a founder in a relatively short period of time and get him or her to say, I want to partner with Trivest to the exclusion of the other firms that are calling on a daily basis. There's an element of sales, and it's not just sales. I say we have all these corny phrases like just say no, which is how we structure our transactions to be easier than other firms, or path to 3x, right? We have all of these corny expressions, but we also have the data to back it up. So I don't want to give the impression that we're just selling something, but you have to be personable when you're dealing with founders who, like I tell people all the time, if you think you're going into a founder-owned company with sharp elbows and acting like the masters of the universe that's portrayed in the media, you can really damage a business very quickly. And so we have to go in there, we have to be respectful, and we have to get the ownership, which is typically 1 to 2 people or a family, to say, you know what, these people can help us. And if the founder gets on board with what we're bringing to the table, the management team falls into place very quickly. And so you're exactly right. There is, we take a Main Street approach to private equity, and no offense to our competitors, but they take a Wall Street approach. Even if you just look at their materials, it's meant to impress the bulge bracket investment banks. It's not meant to impress a founder to say, hey, here's who we are. We're honest people. You have 65 founders that sat before you, went through the gauntlet, are now investors in our fund. Do I need to say anything else about our morals and our ethics and our trustworthiness? And it's really kind of getting them to say, like, hey, I'll trust where you're taking me. I trust where you're taking this business. And that's actually the most gratifying and fun part of the job for me. Yes, we're technically capable in running very detailed financial models, but that's table stakes. Like, you better have that or you're not going to be in business. But if you're only competing on price, right, and because you can run all these scenarios and models, you will have okay returns or good returns, but I don't believe you're going to have exceptional returns. You have to bring that other element to the table.
Very well said. We'll leave it there.
Thank you.
Jamie, thank you so much for joining us. This has been a lot of fun. I enjoyed our conversation immensely. I know our investors will also. And I look forward to seeing you again here soon.
Absolutely. Thanks for your time.
Take care.